Well, for more insights on the Chinese economy, I spoke to David Dollar, Senior Fellow with the John L. Thornton China Center at the Brookings Institution. I started by asking about the overall performance of the Chinese economy so far this year.
I would say B+. I mean, we started the year with modest expectations for the Chinese economy. It's been slowing down, but the government set a target of 6.5% minimum rate of growth. It's pretty clear now that we're into December that China's going to meet that and probably exceed it a little bit. So I think it's a pretty good performance. It's relied mostly on domestic consumption, which is a healthy change for China. So you see people's lives are getting better and they're out buying cars and going to restaurants and movie theaters, and that's driving the Chinese economy, and that's sustainable.
Now, let's also look at China's exports, which mildly rebounded in November for the first time since the spring. Why are we seeing this now?
Well, I think the main story there is that for the year, China's exports have been pretty weak. You know, the whole world economy is still relatively weak. U.S. is recovering somewhat, but not great. Europe, Japan, still in pretty weak condition. So China's exports have been muted this year. It looks like that's coming to an end. So the November data were a little bit better. In dollar terms, exports were pretty flat, but in Chinese yuan terms, exports were up about 6%. And that's a healthy change for exporters. They've been facing quite a few months of declining exports in yuan terms. So it's nice to have an increase.
And do you see that as something that's sustainable, a trend that's going to continue as we go into the new year, or is this a blip? What are your thoughts on this?
So I think I think it's not a blip in the sense that the decline of Chinese exports has come to an end. I think they'll be relatively stable going forward. So it's not a trend in the sense that now we'll see a bunch of high numbers, growth above 20% as we saw in the past. I don't expect that, but I think you'll see a solid continuing performance. So it's not a leading sector for the Chinese economy, but it should not be a drag on the Chinese economy anymore.
And as we look at the currency, the yuan depreciation, how do you see that affecting importers and exporters?
I don't think it's had a big effect on volumes. In dollar terms, China's exports were pretty flat. So I think the main thing is that mild depreciation means it's a little bit more profitable for exporters. They were facing a difficult situation. Now it's a little bit better. They're making a little bit more money because of that depreciation. And so I think that helps them. But it's not a big enough depreciation to really affect the volume of China's trade.
And what are some of the sectors that are really benefiting from this at the moment?
Well, China's classic export sectors, electronics, they still export a lot of clothing and footwear, even though they're gradually shifting out of that. Machinery, heavy, certain amount of heavy products, but steel exports I see are actually down. It's a diversified enough sector that it's a lot of manufacturing that's benefiting from this stabilization and slight increase in China's exports.
And as we look at steel exports, we saw that they've plummeted for the 4th straight month in November. Do you think this will play any part in easing some of the concerns that we see from the EU and the US when it comes to anti-dumping allegations?
It should. I mean, it's a little bit surprising, to be honest, but I think China's been trying to rein in some of the excess capacity, so perhaps that's taking effect. Certainly the EU and the US are looking closely at the Chinese steel industry and worried about anti-dumping, but at the moment, there's not a lot of Chinese steel products coming into the US market, for example. So at the moment, it seems a pretty good situation in terms of not stirring up a political hornet's nest.
Now, global growth, as you mentioned, it is still sluggish, and China's still adjusting to this new normal of domestic-led consumption. So as you see China become more open, how do you see that really affecting the trade picture this year?
Well, it doesn't have that much effect this year because China's opening is a slow, gradual process. In the past, a lot of other countries benefited by sending primary products to China, metals and food, and now the food part of that continues, but the metals, some of the industrial materials that China needs, it's just not importing as much as it did in the past. And I think it'll take a while for China to become a major importer of new things, but that's gradually going to happen. For example, a lot of Chinese tourists going abroad, we consider that an export of tourist services when Chinese come to the United States. Even Chinese students in the United States, that's an export of education services. So that Chinese consumption is gradually creating demand for others, but I wouldn't expect it to have a big effect in any one year.
And as we look ahead at some of the potential headwinds and even some of the bright spots for next year, what are the real standouts for you?
Well, I think this current pattern is good. So I really hope we see the continuing growth of Chinese consumption. That's what I expect. I do think they continue to push a little bit at investment. Investment has naturally slowed down, but the government keeps issuing a lot of credit, trying to keep investment at a pretty healthy rate. That's a little bit risky, so it's letting some risk build up in the financial system. I think they would be better off to accept a little bit slower growth, something around 6% that's really consumption driven almost completely. That's going to prove to be sustainable. I don't think the export sector is going to come back in a big way. I think what we're seeing is a stabilization of exports and mild growth going forward, but I wouldn't expect it to grow like gangbusters.